Hello, everyone. Firstly, I hope each one of you is absolutely safe and secure in your respective homes or offices, as the case may be. As India moves or navigates through the various unlock phases, it brings across various challenges, and therefore, mental and physical agility is definitely of utmost priority. As far as the markets are concerned, in the month of September, it was a pretty lackluster move, largely sideways, but moving in, having a lot of volatilities alongside, given that there were certain events that were expected, which could have had market implications. For starters, there was expectation of the monetary policy decision, which now has got postponed till further notice. However, there was the second announcement of the borrowing calendar for the second half of the financial year, which was sort of creating some sort of a butterflies in minds of participants of markets investors. Now, the good news is that of the total targeted 12 trillion rupees INR, 50%, I would say 7.66 trillion. So bulk of it has already been consummated in the first half of the financial year, which leaves just about 4.34 trillion rupees, which has been announced for the second half. Now, this is clearly music to the bond market ears, which were expecting a small slippage, which could have been detrimental to bond yields. So that clearly has cooled off some of the impact of a slightly higher inflation, which was released earlier in the month of September. Even if you look at the inflation trajectory, the numbers incrementally are showing a decline, which gives us reasons to believe that the next few readings on inflation, which is the CPI inflation, could be on the decelerating side. Either which ways, there seems to be reasonable consensus that till such time we see a sustained drop in inflation, it is highly likely that the Reserve Bank of India will be on hold for the remainder of the year 2020. A small window of rate easing could open up probably as inflation decelerates into the year end. So, probably in the first quarter of 2021 calendar year is when there could be a chance of potential easing. However, let's not mistake a long pause as a departure of accommodative rate stance. The month of September also saw the Reserve Bank of India support the bond yields. A, through secondary market bond purchases, and B, most importantly, open market operations, including Operation Twist, wherein they bought almost 40,000 crores worth of long bonds and gave in supply similar quantity at the shorter end. Now, this has dual objective: A, to help anchor the yield curve at the current levels, and B, most importantly, try to shrink the yield curve, which is reasonably steep at the current juncture. The reverse repo rate currently and the 10-year benchmark government bond curve have an yield differential of a little under 3%, which is a reasonably high spread to reckon with, and therefore the Operation Twist is a step in the right direction to achieve some bit of contraction in spread. We also saw corporate bond spreads compress in line with what we have been expecting, and we continue to believe that in a surplus liquidity scenario, it is likely to see some more spread compression, especially in the high grade names. What should market participants expect going forward? So, the month of October is likely to see the announcement of the MPC decision, which the date obviously is not yet known, but that would certainly be one of the events that the bond markets will look forward to, not from an action perspective, but more specifically from a rate guidance perspective. The second most important event is the inflation data for the month of September. As stated, while we are seeing a decelerating trend, the stickiness is a little bit unnerving to the bond market participants, and therefore there will be a watch out for how soon and how much more the durable decline in inflation will last. These are the two key events which markets will look forward to, and therefore Given that the bond market has not been intimidated by a huge supply, and the fact that Reserve Bank of India stands committed to intervene in the market as and when required, is likely to support the bond deals, and we are at best likely to see range bound tight trading ranges for the bond deals in the coming future. We also believe that the Reserve Bank of India will maintain reasonably high liquidity in the banking system as the environment continues to remain uncertain. And the last thing RBI would want to do is suck out the liquidity in an abrupt manner. So a combination of comfortable liquidity, a combination of not so high supply, and a potential of lowering inflation in the coming months is likely to keep the bond markets fairly supported with a marginal easing bias. We also saw the month of September, the foreign portfolio investors be net buyers in government bonds and corporate bonds, basically the Indian bonds over equities where they were net negative. While it's too early to call it the start of a trend, it certainly is encouraging to see some demand levers support the bond markets apart from the domestic demand. For investors, we still maintain elongating the yield curve, elongating your duration on the fixed income, and staying invested despite volatilities would be the game plan going forward. On that note, stay safe, take care, and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.